Hello, welcome folks to today's session on a tactical outlook, insights and strategies to capitalize on Hong Kong's volatile markets by Mr. Kevin Liu. He's the Managing Director of CICC Research, and after his session, we'll have a short one on structured warrants as well by Isabelle Zhen, that is me. So I just want to remind you that we've got 3 key takeaways that you can take away today. If you choose we will be choosing the top 10 comments on our Facebook page. We'll send the link over shortly. And you'll be entitled to win 100 ringgit Shopee vouchers, just as a little thank you and incentive for joining us here today. So earlier this week, we had Mr. Johan Lee from Honghu Capital Management. He handled more of the technical view on the markets. And today we're going to have Mr. Kevin Liu, who we're very excited to see. Earlier, I noticed that a lot of you are joining in, and I really appreciate it because I know our Prime Minister has actually announced the public holidays tomorrow and the day after. So it's kind of like as if you guys are here on a Friday night, right? You're supposed to be going out, but you're actually spending your time to improve yourself and learn a bit more on a Friday, so-called Thursday night. If you don't mind, just let me know where you guys are from. I'd like to get to know you guys better, and I see a lot of familiar names on the chat as well. So let me know where you're viewing us from, and we'd like to get started with Mr. Kevin Liu. Kevin, can you hear us?
Yes, Isabelle. Good evening, loud and clear.
Oh, so happy to see you. Where are you zooming in from today?
From Beijing, actually. Same here. Very glad to see you.
Yeah, you've been so busy, and I really appreciate you making the time for us this Thursday evening. Even though in Malaysia it's a long public holiday weekend, but the people who are here today, they are dedicated, they are ready to learn, and we look forward to hearing all of these exciting strategies and insights from you, Kevin. Over to you.
Sure. Thank you. I want to first express my gratitude to have such opportunity to be invited to share our view regarding Chinese market. And a lot of things has happened over the past half a year, especially the past quarter. I have traveling to Singapore roughly 3 weeks ago, and finally we can go abroad. And China is reopening. Same for the market has been reflecting the recent market trend. So a lot of the things happening are really, being changing. Really excited about, sharing our view, and I also want to, express our latest house view regarding Chinese market and economy. Before I get started, I want to briefly introduce myself. I'm with CICC since 2011. So over 12 years career with CICC, I mainly cover Chinese market from the strategy perspective. And prior to CICC, I was with UBS in Hong Kong, also covering the Chinese market on the strategy, quantitative strategy perspective. So let's get started. Let me share my screen. I have a presentation to better navigate Chinese economy and market. As I have said, China has experienced a lot of change over the past quarter, especially in this year, since the policy optimization and also the improvement of the COVID policy. China is reopening, and also we see the latest first quarter economy data show very strong, very notable recovery from the trough. So the first thing I want to highlight, the key information I want to say regarding 2023, the China market is pretty simple and clear, just as shown as the title of my presentation. China is heading into a new chapter regarding the economy, regarding the market. And I think you already noticed that, right? I mean, a lot of things has happening. But the next question is to ask is, how strong the recovery will be, and how do we ride on China's reopening, the apparently better economy recovery compared to the rest of the world, and how do we bet on that? So let's start from the bigger picture, which I refer to as the economy cycle. So apparently, China recovers first, while the other economies are still slowing down, fighting for inflation, or maybe fighting for like financial instability, like the banking problem over the past few weeks. It's probably not over yet. We still might see some contingent risk, from here, there. The bottom line is China is recovering. You have better growth. You have recovering corporate earnings, and we don't have high inflation. So that's the bottom line. That's the bigger picture. China's economy recovers first. The second thing I want to talk, is about the policy cycle. We show the bigger picture, and within the bigger picture, we can talk about the economy trend and market trend, and also sort of, I have an idea of investment. The policy cycle. External policy cycle, we all know that United States, the Federal Reserve, is probably heading to the end of its tightening cycle due to the banking problem, due to the already moderating inflation. Although we still worry about the sticky part of the inflation. So we can draw the conclusion that Fed is about to approach its end of the policy tightening cycle, which means is disturbance for Chinese market from external side, from the external environment and liquidity side, especially for the offshore Chinese market, could relatively ease or relatively moderate, and also from the monetary tightening to credit contraction will also help United States to tamp its inflation, but also, in my opinion, inevitably heading into recession. The only thing is whether it's going to be a hard landing type of recession or just a mild recession. And it will present as a very sharp contrast as U.S. is still heading into slowdown or recession, while China economy is recovering. So that's the very sharp comparison for both economic growth and also the policy cycle. So China is still in the easing cycle, although we don't think further easing will be necessary, given we already are at quite low level of funding cost right now. We already have very ample liquidity condition, but we are still at easing cycle. There's no tightening pressure in sight in any near future. That's the key difference. Although we don't expect further aggressively easing, given already very ample liquidity condition. So that's another sharp contrast on the policy side. So if we look at Chinese market, you may wonder, okay, if China's economy is recovering, and also, last year we have easing liquidity condition for China. We have been easing since July 2021. Why Chinese market haven't performed well, especially last year, especially for the offshore Chinese market? The thing is, if we look at the key variables affecting the Chinese market, especially for the offshore Chinese market, we have the growth, which is the China's economic growth, but we also have the liquidity condition, which is determined mostly by the Federal Reserve. So think about 2020 to 2022. China's growth continued to slow down, while the Federal Reserve continued to tighten aggressively. So all those two things actually put pressure, headwinds for the market. But heading into this year, as I just said, Federal Reserve is about approaching its end of the tightening cycle, and China's economic growth is recovering. So you have both tailwinds to support the recovery from the trough of last November. That's the idea. That's the key determinants key variables determining Chinese market performance from the top-down macro strategy level. We already know that, right? We already think, those policy optimization and also the expectation for Federal Reserve tightening cycle since end of last year. And also explains why Chinese market actually outperformed the rest of the world. But the thing is, next question we want to ask is how strong it will be. And what kind of a recovery path going forward? In order to answer that, we have to take a step back to really look into those what we call like a previous trouble. The previous trouble facing China before end of last year is what we call the lack of growth expectation. We have been easing. China has been easing over one and a half year since 2021. But the thing is, when you have a continued decline funding cost, you have even faster dropping cost of return expectation. In that circumstance, people are still reluctant to consume, to spend. Corporates are reluctant to do more investment. So that's the key. And that also leads to the huge accumulation of deposits, which show on the right-hand side figure of my presentation. But things has changed. Since last October, the policy optimization, the reopening, the three arrows for the property market, all those policies are directly targeting at one thing to revive, to lift the confidence of future economic growth, or put in other words, the return expectation for assets for growth to directly address to this issue. Think about that. We have a lot of deposits sitting on your balance sheet, sitting on your banking account. And we don't have the inflation problem. The CPI of China actually declined last month. You have ample liquidity. What you just need is better growth expectation. With that, you can transfer all the liquidity into the real economy, into more consumption, more investment, and to support the economic growth. So the real answer we have to answer right now, the real question we have to answer right now going forward, what could do the job to do credit expansion from monetary easing? We already think things has changed and sentiments improved. Let's break down all the growth drivers and see how strong the recovery will be and what kind of a recovery path it will be. These three charts actually give you a vivid example of growth recovery since the reopening. The daily coal consumption, the passenger, airline passenger, and also the subway. Take myself, for example. I have been traveling over 20 times up to now since opening this year. More than the total traveling I have done over in 2022. And one of the time when I travel from the other city back to home, back to Beijing, because all the high-speed train are fully booked, I have to buy a so-called standing ticket to get on the train. So it's really reopening, and the traveling, the catering business are quite crowded and show a very, very, very huge demand. So we have to break down, as I said, we have to break down into details to see what kind of driver can drive economic growth and what kind of a recovery path we could expect. CICC macro team expect a 5.5 GDP growth target, and we expect roughly 10% of earnings growth. The 5.5 GDP growth target is a little bit higher than the 5% GDP growth target set by the annual session. The NPC meeting just concluded around March. Although still a lot of investors are questioning whether China can deliver such a good growth over 5%, I think the the concern, the questioning of such, the concern of such kind of a question will actually decrease after China just posted very notable, very strong first quarter data. But the key debate, if we break down into key drivers, consumption, exports, and property market, the key debates are still there, especially on the property market data. We expect the property investment will deliver a 0% growth this year, meaning that there won't be any drag for the property investment. But some bearish investments think, it could be a little bit negative, in the negative territory, like -5 to 0. So let's take a deeper look to see how we come up with those numbers. First, the exports. Exports going to see pressure, to be honest, for China, because last year has been so good for exports, for external demands as a key driver for China's growth. But heading into this year, we have the recessionary pressure for United States. We have a still elevated inventory for U.S. corporates. It's hard to imagine that exports will be the key driver for China's growth. So exports is very naturally and understandably to be a little bit drag for this year. But don't underestimate the resilience of China's supply chain and its capability to supply the goods for global economies, even when global economies are still facing downward pressure. For example, the March data actually beats the whole street expectation. If the exports will not be the driver, and also see a little bit drag, manufacturing investment in this circumstance will also see some wins, because manufacturing investment used to manage supply for exporters. So we don't expect exports and manufacturing investment to be the key driver. So giving that backdrop, giving that assumption of exports, we think manufacturing investment is still, going to take some time to recover. Therefore, we are a little bit neutral to kind of a conservative regarding industrial goods. But that only leaves us with property market and also consumption. Regarding property market, we already see notable recovery after 3 arrows to support the property developers, and also after introduction of various demand-side policy. Actually, you can see the chart, the figure on the left-hand side on this slide, the red line, it recovered quite notably last month to show a notable sales recovery for the existing home sales, and also price hike in certain cities. So this already recovering, and it's the done deal to see a positive growth for property market sales this year. But the thing is, how strong it will be going forward. We don't expect it's going to be a key driver for growth this year, because we think the existing home sales will be recovering, but it won't be strong enough to help sort of help the property developer to acquire more lands and do more investments. It's going to be supporting the growth. It's going to be recovering, but it's not going to be that strong to be a key driver for the whole economic growth. Because given the still continuous policy restriction on purchase in some cities, you can see in the middle, the table in the middle, only 3 cities actually introduced relaxation on the purchase restriction, for purchasing homes in those cities. So without further policy relaxation, we will continue to see recovery of the property market, but it won't be that strong I mean, that is also understandable because China won't simply rely on property market to be a key driver for the economy, but it's recovering. And also that has been reflected by the property sector's performance. The introduction of the three arrow around November last year actually helped to lift the property market all the way from 0.5 price to book ratio to 0.585 price to book ratio. But it stayed there for roughly 3 months. Because whenever you expect it past 1 times to price to book ratio, it implies the property developer want to acquire more lands and do more investment. That's not our best assumption. We just assume like the property market demand will recover, but it's not going to be that strong to support massive investment on the property side. So with that, as the moderate growth driver, let's look at the consumption. The consumption has been quite strong for several reasons. First, you have the pent-up demand after the COVID. As I said, I've been traveling in just 3 months more times than the total traveling back in 2022. And in China right now, if you want to, book a restaurant, you have to book in ahead, like in advance for a couple of days. And everywhere is packed, especially when we're heading into the May 1st national public holiday. And also we have a lot of a deposit, don't forget, sitting on there. The right-hand side figure actually shows that so-called excess deposit, saved during the COVID. That kind of excess deposit, will help to support the consumption, especially after people can go outside, can travel, can do more like social with friends, and also do more catering, tourism, etc., and business travel. And thirdly, we also expect, if people are not buying more cars and more houses like they have been doing over the past few years, they might spend more money into consumption. And on the right-hand side, you can actually see the catering category of the retail sales has rebounded more notably compared to other categories. And going forward, we expect, the consumption going to recover roughly back to its long-term trajectory. But without the notable recovery assumption for the property market, yes, it will still miss a part of the big ticket consumer goods, consumer durables. So meaning that, we have a much stronger offline consumption, but we have a little bit drag, a little bit shy of the long-term trajectory of the big ticket consumption directly linked to the property market. And put it together, we're going to have the moderate consumption recovery. And if you put consumption, property market, exports, and manufacturing investment, all I have said, all together, that's how we come up with the 5.5 GDP growth and roughly 10% earnings growth. That's how we come up with the growth expectation for this year. So if we put the China's growth picture and also the Federal Reserve policy cycle together, we will see more clearer picture for what the market will look like this year. So the best case scenario is that China is going to recover moderately. I mean, that's kind of a done deal. The only question is how strong it will be. What I just said is we believe in a central case is going to be a moderate recovery. If the property market can, show more policy supports to relax more purchase restriction for more cities, we could expect even stronger growth. But that's not our best case scenario. That's kind of a bold case scenario. And on the other hand, we don't expect Federal Reserve to tightening any longer, or maybe another couple one to two times. So that actually resemble 2019 very quite a lot like 2019. Because 2017 on the left hand side, we know the U.S. is still tightening, right? But 2019, you see the gray area. Federal Reserve is approaching its end of tightening cycle and finally cut rates. But more importantly, in 2017, both China and the US actually witnessed a very strong growth recovery. But in 2019, on the right-hand side, especially the red line, China's growth recovery, but only moderately. You see the PMI, it actually flattened. It actually, stayed in the positive territory for a while. So that's more like this year's combination. We don't have further tightening in the United States, but we have China's recovery, but moderately. So put those two macro conditions together. That's how we come up with the future path. Future path. We all know that the key two variables determine A and H share market and different sectors and assets are two key variables, which are first the Federal Reserve policy and also China's growth. Look at the left bottom quadrant right here. That is exactly 2022. China's growth slowed down, and the U.S. continued to tighten, which leads to a lot of headwinds for the Chinese market. And the right top quadrant is exactly what happened since November last year. But it won't last long. In just a couple of months, it's over. So what leaves us is only the base case like 2019 and also the bull case like 2017. The base case it looks like quite similar as 2019 because China's growth, as I show you, is moderating while US stopped to tighten any longer. So that actually gives us what we call structural opportunities. You have to focus more on alpha rather than beta. It's more like structural opportunities rather than index level rally. If we want to see a bull case, what we will watch for is the property market policy. The property market policy could be a key to support a much better growth going forward. And with that, we can expect a much better earnings growth and also a much better index level rally. But the best case is right here. We can see a moderate recovery and structural opportunities for this year for Chinese market. The market performance actually resemble and also reflect the macro environment back in 2017 and 2019. Here is the 2017. 2017 has been so strong because you have the shantytown renovation, you have the property market to be the key driver of the growth. It has been so strong. The gray line is the offshore Chinese market. The red line is the Asian market. It has been so strong. Even the Fed is still tightening back in 2017. The H shares actually outperformed and the property market actually doubled and tripled. And also, RMB continued to appreciate against US dollar. Foreign money continued to rush into the Chinese market, even as Fed is still tightening back in 2017. And the key driver then, the only reason behind that is China's growth has been super strong. But we cannot assume China's growth has been that strong without the support of the property market. We only expect it's going to be a moderate recovery. Then the market will be more similar as the 2019, which as shown in the red box on this chart. In the first 3 months, both markets A and H share market recovered very sharply. It's a repeal kind of style recovery. But after it recovered back to its normal level, it started to fluctuate. It started to fluctuate on the moderate growth, on its fear of the U.S. recession, and also the trade friction back to 2019, the third wave of the trade friction, trade war between China and the U.S. So on the index level, look at the gray line and the red line. It fluctuated within a narrow range. If you look at the recent market performance, it looked quite similar, right? But don't get me wrong, even the overall index fluctuated within a narrow range. We can still do structural opportunities like the TMT and also the internet space, TMT in the Asia market and the internet space in the offshore Chinese market. And 2019 is what we call structural bull market, because even the overall index seems like a little bit lukewarm. You still can gain a lot from the structural opportunities on the alphas. And that's gonna be happening in our best case scenario for this year's Chinese market. And for RMB, it depreciated against US dollar back to 2019, even the Fed is still easing. So Fed easing actually can help to ease the external pressure, but it's not going to be key enough to drive up the overall index level without notable earnings recovery. So a moderate growth recovery will give us structural opportunities. Corporate earnings for Chinese market are going to recover, but we expect a 10% earnings recovery compared to last year's decline. 10% of recovery will mostly be seen in the downstream sectors. We have recovery in the consumption after the optimization of the COVID policy. We have pent-up demand to support the more consumption. We have lower commodity prices to help the downstream to see margin improvements of the net margin and a reduction of the cost. So downstream sector will see higher chance to recover compared to the overall corporate sector, especially for the upstream. This is the breakdown of the A and H share markets sectors earning expectation. You can apparently see downstream sector are kind of expected to be better off compared to upstream sectors. Valuation for both A and H share market are still reasonable or even still cheap compared to their historical level and also to global peers. Especially for the offshore Chinese markets, the so-called old economy index. Even with recent rally since last November, Chinese market are still trading at a relatively reasonable level if you compare that with the United States, with other markets. So that is actually not a big concern for Chinese market. We still have a lot of room to recover on the valuation side going forward. The other thing I want to highlight is the fund flows. Think about the overall picture. China's growth is recovering while the rest of the world is slowing down or fighting for inflation or still tightening. China has experienced, to be honest, last year, experienced a lot of outflows due to the narrative of uninvestable or geopolitical tension. That can be reflected by the light blue line on the bottom to see the outflows last year. But the largest pressure for the outflow has already behind us. Because right now, if you look at the allocation for global various funds from various regions, it's all approached to historical low level. Together with China's growth, recover while other economies' growth are slowing down. So to a certain extent, China could be the safe harbor for certain foreign investors. Think about that. In this kind of global markets with a lot of uncertainties, what do you want is actually the certainty. You want to seek for certainty among all the uncertainties. And for China, we have relatively low valuation. We have, recovering earnings, although not that strong, as I said. We have a relatively low allocation for global funds. That's kind of a certainty. I'm not saying the market is going to deliver like 50 or 60% of our index level rally. At least it could see the downside protection, right? It won't be like last year, China's growth slowing down and the Federal Reserve is still tightening. It won't be like that. So we have downside protection. So whenever it's cheap, you can expect a mean reversion to at least give you, 10, 20% of recovery. That's what we call certainty. So China could serve as a safe harbor at a certain point of time for foreign investors. And here is the demonstration of different funds from different regions to gradually add position for Chinese market. You could see regional funds add already 5% of their allocation to China since last October, is approaching 60 to 80% of percentile of last 10 years allocation. US funds and European funds are lagging behind. It's still going to take some time. It's still at a very low allocation percentile back to, compared to last 10 years. But we think it's gradually, coming back as long as China continues to deliver much better growth going forward. So giving this as the whole picture and the best assumption of Chinese economy and market, we have two recommendations. The first is regarding the overall market. So remember what I said regarding China's economy, we are recovering but moderately. Federal Reserve is probably approaching its end of tightening cycle. So put it together for the market, we have downside protection, right? That's kind of a done deal. But the upside is also a little bit capped by the growth potential. If we assume 5% GDP growth, if we assume 10% earnings growth, the upside could be capped by that until we see more policy support for the property market to support much better growth, much better investment. But that's still going to be not enough, right? It's going to be like, we have a downside protection, but we can do the range bonding, you can trade the volatility, you can, buy on dips when the market experienced some correction. As long as we know there are going to be downside protection. So that's what we call volatility. The other thing is certainty. If the overall growth is recovering but only moderately, what you want to do? You want to bet on certainty, just like you want to bet on certainty on China as a safe harbor against all the certainty of the global peers. But where could you find the certainty? Just two words: cash flow. Or maybe just one word, cash flow, right? So that's what we call barbell strategy. It's like a barbell strategy. On one hand of the sector spectrum, you search for high dividend. The high dividend payout to give you dividend cash flow is just like an 8% of perpetual bond. That is going to be very attractive, right? And if you're familiar with the recent market performance, that's exactly the strategy, what we call like SOE with high dividend payout potential for Chinese market. It rebounded very sharply recently, outperforming rest of the market. And on the other side of the spectrum of the sectors, we recommend you to focus on the growth sector, which are expected to deliver much stronger growth, for example, 30% compared to the overall 10% of earnings growth. So quality growth. So dividend yield and quality growth like a barbell. That's what we call barbell strategy. And the barbell strategy all comes to the cash flow, the certainty. And that is exactly what we feel like a feasible strategy in this kind of environment. So high dividend plus technology and internet for the Chinese market. With regard to biotech, I also want to remind you that you could watch for that in the second half, whenever the Federal Reserve has better, has much clearer tools for potential rate cuts, because biotech names are even more sensitive to the denominator, the funding cost. It has very little cash flow. It has very huge terminal value. So rely heavily, very sensitive to the change of the funding cost. It could be a main source of excess return. So that's the H-shares sector allocation strategy, a barbell allocation strategy. With regard to the high dividend yield, I just want to, add one more point on that. Recently, China has introduced the new evaluation metrics for SOE. It changed its evaluation indicator from previously the net income to ROE. Think about that. If you change it to ROE, the quickest way, the easiest way for SOE to lift its ROE is just to increase its dividend payout ratio. By increasing dividend payout ratio, you essentially decrease your equity and making your ROE much higher. And by doing that, the SOE also, return more money to their biggest shareholder, which is the government. Is also politically a very good thing to do. So what you want to do is to find SOEs they have the incentive, right? What you want to do is find the SOEs with the capability to increase their dividend payout. So you look at the SOEs with relatively lower dividend payout ratio, meaning that they have more room to increase and also have the capability to increase. For example, very good free cash flow, and also more net cash sitting on their balance sheet. That's how we combine the SOE and high dividend. That is exactly what we call one side of the barbell strategy. Essentially, if you hold them as a basket, you're holding an 8% of perpetual bond with a little bit option value if they could successfully deliver their reform for the SOEs. Talking about the near-term strategy, that's our recent and near-term cyclical market strategy. I still want to highlight a little bit more about secular trends when we look at China. China has experiencing 3 different growth cycles if we take longer term view over the past 2 decades. Right now, China is heading to what we call structural transformation, to consumption-driven, to kind of industrial upgrading-driven sort of a territory. We cannot simply rely on the property investment on leveraging up. That's why we don't assume property could be a main driver for the growth this year, because the policymaker already realized it's not going to be sustainable. We cannot simply further rely on the property market. This kind of economy structure restructuring the growth drivers, transformation has also been reflected by the capital markets, with the new economy continue to grow, while the old economy continue to shrink, as shown on this slide. Going forward, we think there are a few long-term trends. If you want to focus on China, right on China's growth over the longer term, rather than just next few quarters, as I said about the barbell strategy, I want to highlight a few trends. The first one is what we call technology innovation. Think about the TMT, think about the ChatGPT, think about the AI. China has to catch up because it's the only way to successfully to shrug off the high reliance on property market, to fend against all those supply chain disruption and geopolitical tension and US-China friction. So China policy has to put more resources on this sector. China policymaker has realized its importance, and you're going to expect more policy support on this. So that's the long-term strategy. That's the long-term story for China to do. Technology innovation and industrial upgrading. So we are medium to long-term positive on the advanced manufacturing and technology for China. The next thing I want to highlight is what we call consumption upgrade. If not due to the COVID, you can see the comparison of China and US consumption. China almost exceeded US in terms of the total consumption back to 2019. We have the mass market, we have the potential to revive, to lift more consumption. So that kind of a mass market will be the ideal environment for consumer brands to grow, especially for local consumer brands to grow and go global. And that's the experience also happening before in Japan, in other economies. You have more contribution from the consumption, and also see the consumption upgrade to better demands for recreation and education. And the reason behind what we call consumption upgrade is the income increase, the manufacturing advantages, the competitive pricing, and also young people preference. And mostly the channel, use of different kind of channel, the online channel, the e-channel, the internet. We also have to franchise all the consumption. The homegrown brands go global. That's the whole idea. So industrial upgrading, technology, consumption upgrade, and also the last trend I want to highlight is wealth management. The growth of the Chinese capital market, and also the growth of Chinese capital market to help the financial industry to funding the real economy. So those three trends, if we take a longer term view, regardless of the near-term cyclical economy cycle, I highly recommend you to put more attention on those three trends for China. And that's going to be happening over the next 5 to 10 years. And that's going to be, how we play and ride on China's growth potential. So with that, I will stop here to conclude my presentation to basically, give you the whole idea and our view regarding China's near-term growth, near-term market performance, what we think the market will do in the next few quarters, and more importantly, the next 3 to 5 year secular trends. So with that, I will hand back to you, Isabelle.
Thank you so much, Kevin. That was really insightful, and I especially appreciated that session that you did about the Fed easing, and you showed that long-term charts where you showed the correlation between all the different incidences that happened over the years. And that Made in China bit about the long-term trends, that was very interesting for us to notice as well. Because sometimes in Malaysia, we might not notice all of the trends. We only see them many weeks later, but you have put them in such a clear order that it is a joy to watch your talk. And also congratulations. I didn't mention the other day, but for our viewers over there, we saw Mr. Kevin Liu on CNBC, wasn't it? Or was it? Wait, I believe it was on CNBC that we saw you in the news, and I turned around and I was like, I recognize that voice.
Yeah, it was Bloomberg.
Bloomberg,
a couple
yes.
weeks ago. Yeah.
Yeah, fantastic. Anyway, we're so
Thank
honored
you.
to have you. We'll just jump into the questions straight away.
Sure.
So, a question from Seong Kok Tan: Is China able to achieve the GDP forecast, and how the government manages CPI? Any surprises that you foresee?
All right. I think it's actually not very hard task for China to deliver 5% GDP growth target, especially after we see a notable and much stronger than expected first quarter data. Think about that at the early of this year. A lot of people worry about the potential downside risk for exports, but it turns out to be, much resilience for the exports. Meaning that the drag is a little bit smaller compared to people feared at the beginning of this year. And the consumption is going to be much stronger. Although property market is still key debatable area for people to argue, say, whether it's going to be strong or maybe just, pent-up demand is going to weaken over the next few quarters. But I think with what we already achieved in the first quarter, the government and even its autopilot, we don't have to see too much policy support. We can still deliver 5% GDP growth. And the reason why I break down those key drivers, our assumption is only kind of a moderate. We are not very aggressively doing the assumption. 8 to 10% of consumption, 0% property investment, and negative export growth. And they're all kind of a relatively moderate assumption. We can still achieve 5 to 5.5 GDP growth. So the answer is yes, and it's not a hard task. But the only thing is, if you want to see much stronger growth, we have to rely on the property market, more policy and more investment. So that's answer for the growth. And for the CPI is still in the sweet spot to not seeing any sign of notable increase of the price pressure. Especially for this month. So heading into the second year though, heading into the second half of this year though, we do see a little bit price hike pressure due to the monetary easing, due to the recovering of consumption demand, especially for the offline consumption. But there's no chance for China to see like the inflation pressure compared to the global developed economies like the United States. So the bottom line is, although we don't expect further monetary easing, but we don't think it's going to be a big obstacle for policy to tightening anytime soon.
Wonderful. So it sounds like you said if China is just an autopilot, they don't do anything spectacular, 5% is the base minimum that they can achieve. And anything beyond that is a bonus.
Yes.
Wonderful. Ko Soon King is wondering, China's recovery looks promising. What is the immediate short-term upside and downside of China Shanghai Index?
Well, yes, the first quarter data tends to be quite, surprising on the upside. Although the index, the market has not been reacting very positively over the past few weeks, over the past few days. One of the explanation is the market investor are still trying to digest, where the surprise comes from, and they also still have concern or question regarding the sustainability. Just like the first question, people are still thinking, oh, the first quarter has been so strong, whether it's going to be sustainable. It's going to take some time for investor to shrug off, get rid of the bearish sentiments to accept, the economic growth is actually happening. So whenever people accept a new growth path, and finally realize, okay, it's going to be surprise on the upside. Remember what I said earlier in my presentation, we have a lot of money as a deposit sitting on the balance sheet. If you can transfer that money into the capital market, into the real economy, thinking about the liquidity support. But in order to do that, you have to see the positive feedback loop for the market to rally a little bit. So I think the positive, the upside for the market is, the economic growth continue to grow on this momentum, and finally, investor realizing is much better, or at least compared to their bearish sentiments, kind of a more constructive, and also by then we see more inflows from the outside, the foreign inflows. So put it together, we could expect more upside. More policy support in the approaching first quarter Politburo meeting around end of this month. If there are going to be more policy signals, policy support, that will also be a support for the market, the upside. For the downside risk, I think it's mainly come from the acceleration of the growth, especially given the lack of policy supports heading into the second quarter. Because right now, the growth foundation, the growth recovery foundation, is still not 100% solid. It's still a little bit shaky regarding property market and exports. So we still need policy support to continue unfold going forward. So that will be some sort of external, some sort of a downside risk. And external environment will be another downside risk for Chinese market.
Exciting. It sounds like we've invited you at the perfect time then to give us the insights when the market is a bit shaky just before the rally. Given the USD status as a reserve currency under threat, will this present a major opportunity in the Chinese market? Asked by Stephen Tan.
Well, I think Federal Reserve's monetary policy definitely play a very important role, especially for offshore Chinese market, for the Hong Kong market. Think about 2022, Federal Reserve continued tightening while China's growth is slowing down. It put a lot of headwinds for the offshore Chinese market. But since has changed, Federal Reserve is kind of approaching its end of tightening cycle. And I personally think there are quite a lot of good opportunities for the Fed to cut rates eventually around end of this year. But it doesn't matter as long as we can assume that Fed no longer tightening aggressively any longer. It means its disturbance from the yield, from the high funding cost, from the liquidity perspective actually moderate or even diminish, meaning that foreign funds can have the opportunity or maybe can finally return on a better, much higher scale. The only thing is they're still waiting for a better timing, and more signals for China's growth to beat their expectation. So when Fed easing is inside, or at least not tightening, China's growth continue to pick up. That will help the liquidity condition, especially foreign flows, to flow into Chinese market to support the market rally, to change the trend of the continuous outflow back to 2022, if that actually happens. But I want to add one last line for this question. Regardless of the Federal Reserve policy, at the end of the day, the one and key most important driver for Chinese equity are still China's economy and earnings growth. That is the most important thing.
Understand. This question is from one of our very highly profitable traders, Seong Kok Tan. He's wondering, how does China's market impact the Hang Seng Index? Will you see a volatile market in the future?
Hong Kong market is a little bit complicated compared to onshore Asia market because besides the earnings, which are determined by China's economy, it shares the similar earning trend as the onshore Asian market. Hang Seng Index, Hong Kong market are going to be more affected by the external liquidity and monetary policy, external environment, risk appetite, sentiments, etc. So if we assume that remain the same, with that being all the same, how China's economy actually affect Hang Seng Index? Well, the answer is pretty simple. If you look at the comparison I just showed you regarding 2017 and 2019, when 2017, that kind of a growth recovery happens, supported by the property market cycle, supported by a notable recovery driven by the investment and the property market, even the Fed was tightening back to 2017, the Hang Seng Index, the Hong Kong market, rallied very notably, I mean, much stronger compared to Asian market. So what I'm trying to say is, yes, it's more vulnerable, it's more exposed to external environment, but as long as China's growth could be much stronger, it could still be a key driver for offshore Chinese market. But the thing is, for this year, for 2023, we don't expect that kind of strong recovery because we only assume the property market to recover moderately. So for this year's Hang Seng Index, we believe is going to be like wild range bounding. You have downside protection, but the upside is a little bit capped by its earnings potential. So we suggest you more focus on first volatility and then structural opportunities. Structural opportunities means the barbell strategy.
Got it. You're saying that the high tide raises all ships, and China is the tide that can raise the Hang Seng ship. Just that we need to spot the opportunities using the barbell strategy, which he showed us just now. Nice.
Yeah.
Another respected trader of ours, CP Ng, is wondering, which tech companies in China are serious about R&D? In relation to the ChatGPT happening in the West, we know that they are also starting their own ChatGPT equivalent in China as well. Which tech companies should we be focusing on?
Well, I suggest you to focus on those leaders in different perspectives. Well, although I cannot directly name the individual companies, but think about the logic from top-down and bottom-up perspective. From the top-down perspective, as I said, China has to do that, has to do its own industrial upgrading and technology innovation. Put in another word, if we don't do that, there's no way we can achieve more sustainable growth heading into next decade or next several decades. Population dividends fading out, the supply chain and globalization fading out, the leverage is already reaching quite high level. So that's the only way we have to do. That means we're going to receive a lot of policy support on this, and also policy makers focus are many on this. So that's from the top-down perspective. From the bottom-up perspective, you think about why I say leaders, because only the leaders have the capability to achieve their goal, to use various resources to achieve their goal, to do the technology innovation. You can focus on three areas. First is what we call infrastructure. In order to achieve that, you have to have the infrastructure, computing, resources, the network. For example, Chinese telecom providers, there are key beneficiaries. One of the key beneficiaries, for example, those China key chips manufacturers, they're gonna be key provider for those chips. And also the second area you want to focus on is algorithm. So those cloud computing, the software designing, those leading names are most likely to do the job. And then application. You have to make those ChatGPT and new technology to be applicable to the daily life, to the business environment. But put all those three together. I do think those don't underestimate the capability for those internet giants, for those leading platform economies to do all of them. So I'm personally positive, constructive on the internet space. also based on this kind of a rationale. Those leading internet giants actually have the capability to do all those three and to take the advantage of their research and R&D capability, and also take the advantage of their resources on the platform on the internet to integrate and combine all them together.
Gotcha. So choose the leaders from the tech giants and make sure that they hit all the three criteria that you mentioned just now. Make sure they tick all the boxes. Okay. Jason Tan is wondering, Hang Seng Index has been down for the last 3 years. Will you see Hang Seng Index recover this year? And what is your view on Hang Seng Index range this year? I know it's up to you to reply that as you like, Kevin, because I know you don't give exact points, but I'll leave that to you.
Sure. I will skip the exact level of the index, but I will say first, we are medium-term constructive for sure. We see downside protection for the market. If you could refer the previous bottom happening in the beginning of this year, that is our bottom downside protection. The reason behind that is very simple. As I said, China is recovering, although moderately, but Fed is no longer going to be aggressively tightening. Those two things going to be the downside protection. But for the upside, we see 10% of earnings growth. And right now, the valuation are 10% lower than its reasonable level. So it's a simple math for us to get the index of upside potential. But what is more exciting, as I said, compared to the index level overall opportunity is what I call structural opportunity. Especially, what we said about those areas directly benefiting from, better growth, policy support, and also, high dividend payout. So structural opportunity is really more, more focused, I want to suggest, compared to the overall index level. But even for overall index level, we can easily see that kind of a rally from this level. Yeah.
Another question from Seong Kok Tan. He's wondering, the Hang Seng Tech Index was down 27% last year. What do you think about Hong Kong tech this year? Will Alibaba's restructuring plan help to push up the entire sector?
For Hang Seng Technology Index, yes, it was under a lot of pressure last year due to various reasons. We do see, it going to recover for the similar rationale compared to the overall in market. But it represents the structural opportunity I just said. One of the end of the barbell strategy I referred to. So the barbell strategy is, one hand is the high dividend payout, the other is quality growth. And for quality growth, when I say quality growth in the offshore Chinese market, I refer to internet. But for internet, you have to be selective because not all the internet giants can deliver much better growth given their competitive landscape and also their regulatory environment and also their growth potential. The split happening right now gonna do the job to revive the sentiments, because whenever they can do split, that means they can put their most profitable business unit to get listed, and also they are sending a signal that they receive green lines from the regulator to finally to get listed. So that is probably more important for the internet space. And there are also another portion of the Hang Seng Technology Index is the biotech. I think biotech is a very interesting space to watch for in the second half, because biotech companies have very little or even no near-term cash flow income, meaning that is have a huge amount of terminal value, meaning that is very sensitive to the funding cost. Think about that. in the second half, whenever the rate cost is getting, much clearer, the biotech sector could rebound very sharply to give you a quite notable excess return, but that's going to take some time. So that's what we think of the growth space, or put in other words, Hansen technology in that.
So we see a lot of potential in these sectors, but I think what a lot of foreign investors fear is that the Chinese central government is immensely powerful when it comes to regulation. So the American way of doing things is they look at future PE and they price according to that, right? They price in earnings that have not even been realized yet. But for China, the main thing that people are mainly concerned about is regulation from the government. Just a random question on the side, is there any way that you look at a leading indicator for what the Chinese government is going to do for the year? For example, do you look at how most people do it? President Xi, they count how many times he mentioned the word shared prosperity. And they say, oh, he mentioned it many times this year. That means this is his intention. What is your leading indicator for the Chinese government's initiatives?
Well, to be honest, I think we have to accept a new normal for the regulatory environment. Unfortunately, it's definitely changing from the last couple of years. But the good thing is the inflationary, the regulatory pressure, I think, is kind of the most part of the regulatory pressure is already behind us. We don't see any incremental, especially for the internet space, incremental regulatory pressure this year happening due to few reasons, because they already introduced quite a lot. And secondly, you have a more important agenda to support the growth, and internet company still do play a very important role for the employment. So one of the really interesting leading indicator is just look at the media reports, especially the propaganda from the state media. That recently, especially including the top decision maker, when they mention the private sector, the internet, they all say, okay, we're gonna support the property sector. We're gonna support the private sector. We understand their concern. The state media also report that we're not gonna tolerate negative kind of a speculation regarding the private entrepreneur or companies. This all shows early signs of the changing of the environment for the private sector. So that's actually tells something. I'm not saying there won't be any regulatory pressure, but think about that. It's a pretty simple rationale. The property market and the internet space cannot be tightening regarding the policy at once for this year. If they do, it's just 2022. It's just another version of 2022. If we don't expect the property market to see more policy easing, the internet space won't see any policy tightening. So that's very simple kind of rationale behind the policymaker want to do. So yes, we still gonna see the policy be there, but it's not going to be incrementally increasing. Actually, why those companies can split can also show can also send signal to split their business unit to get listed. I think it just one of the as I said, one of the important signal is that it actually sent the signal they received the green line from the regulator.
That makes a lot of sense. It's like saying that it's just going to be Groundhog Day if it happens again, which means the same day happens again because it's happened in the past, right? Well, if you want to see what's going to happen if the property regulation tightens up, it's already happened. So it's just a repeat of 2022. Now we're going to zoom out a bit further for this question from Lee Yao Lam. Will we see a recession in the US this year, and how will it affect the Hong Kong Chinese markets?
Why? Well, we have to think about in different scenarios. If the U.S. going to head into a relatively mild recession, meaning that growth slow down, demand slow down, yeah, a little bit, for example, 0.5 to 1% of GDP growth. I doubt it's going to have very huge negative impacts on the Chinese economy on the market. It's mainly going to be affected while the export channel. It mainly affect the markets while the sentiment perspective, because U.S. market, when they see recessionary pressure, you're gonna pull back a little bit. You're going to pull back, due to the recession fear, and it's going to affect the Hong Kong market from the sentiment and risk appetite, and then it's going to affect the export demand, exporters' price performance due to the weakening demand. But it's it's not going to be end of the world. But the worst thing we want to avoid is a very ugly hard landing kind of scenario, especially when you see the credit crunch from the banking crisis. That means if you substantially increase the possibility for U.S. to expand its current kind of a growth recession to a full-blown financial crisis. If in that case, they're going to affect the global markets, including offshore Chinese market and also Asia Chinese market. But I don't think it's a best case scenario. So as long as it's not a systematic financial crisis, credit crunch, it's not a very deep dive hard landing, the impacts could be relatively manageable, mainly through risk appetite, and also mainly through the exports channel.
So as long as we avoid something catastrophic on a global scale, it looks like the effects won't be as hard-hitting as many people expect. And the main issue would be mainly a credit crunch scenario that will be affecting them more than a recession. All right. Dorothy Tan is wondering, what level do you see Hang Seng Index at the end of June and July 2023? Dorothy wants you to look into your crystal ball here.
Well, I honestly hope I have the crystal ball, honestly. But when we formulate our index forecast, there are a lot of uncertainties. I have to admit. Well, again, unfortunately, I cannot give you an exact index level. But what I would say is, we estimate 10% of earnings growth, and we expect the valuation rating, there's still roughly 10%, 10 more percent to go. So put all of them together, 20% roughly. That's our index target. But the thing is, that won't happen all at the same time. Sometimes it won't happen simultaneously. It just gives us a kind of a upside when we combine all of them together. Sometimes the valuation recover first. Sometimes the earnings, follow suit. So you have to bear in mind of that. Regarding June and December, well, I personally think, I have better confidence for June, because the growth could be more like a front loaded. But heading into the second half, there are two uncertainties. First, U.S. recession is probably happening around the third quarter. Whether it's going to have some impacts, although through risk appetite on the Chinese market, and then around end of this year, especially around second half, what we see the policy support is going to support the momentum of the Chinese growth. Whether it's going to pick up momentum, or the momentum gradually fading out, will affect overall index performance. So the near future is more foreseeable compared to the second half.
Thank you, Kevin. Appreciate that. Final few questions, guys. So let's just power through. Joanne Louis is wondering, given the recent change of Chinese government's leadership, all right, will you foresee a new policy or any new policy that will impact the China-Hong Kong market in the near future?
Well, I think, after any two session and a reshuffle of the leadership, a lot of a positive signal has already emerged over the past few weeks. A few things I suggest you watch for closely. First, the emphasis on policy support for the private sector, try to restore the confidence, restore private entrepreneurs' confidence. The emphasis of the continuous welcome of foreign capitals. Addressing the concern of outflows last year, addressing the concern of the China's policy change regarding its capital markets, capital account opening. I think those actually are very positive signals, at least from the policy perspective, try to calm the markets. And the next thing I would suggest to watch for closely is policymakers emphasize on what we call technology and security. It's the rationale I answered in another question earlier regarding China's path of long-term growth sustainability. The policymaker realized the importance for China to build up its own manufacturing and technology capability. So they have to put more resources there to support the long-term growth potential. So that is also one of the reasons why the Asia onshore market actually speculates quite a lot in this area, together fueled by the ChatGPT and AI themes. And the fourth thing is about the SOE reform, the dividend payout theme. Is also going to be an important and interesting theme to watch for this year. I think we're probably going to see more. That's the few things in my mind. I think is important, but I think we're probably going to see get a better idea a couple of weeks away. Maybe just 1 to 2 weeks away, because they're going to have a first quarter Politburo meeting around end of April. That's the first time of the new leadership to convene and to hold a Politburo meeting to discuss the economic condition and also to send their thinking regarding the policy. After all the investigation, when they took office a couple of months ago, so they are currently traveling across China to do the investigation. When they convene around end of this month, we're going to see a clearer signal regarding their policy agenda.
Thank you, Kevin. Great question, Joanne. Looks like we're going to have to drag you back here again, maybe early May, if that's okay, Kevin, to give us your insights on that section. Ladies and gents, if you want to have Kevin again join us early May to tell us a bit more, once those policies come into place, please type CICC in the chat box, show him some love. Our final question tonight, Chai Li Yun. Will the large debt in China provincial government from negative revenues versus provincial state income be a major financial risk? Will the provincial government's negative revenue versus provincial state income, will that be a major financial risk?
Well, I have to say, I received a lot of questions regarding the local government debt issue. Put in other words, the provincial government physical healthiness and stability. That's all comes from the downturn of the property market. Several provinces actually are struggling and see more challenges, especially for the western part of the provinces. They have lower income due to the COVID. They have higher reliance on the property market, which we are in the downturn. So it's understandable and not a big surprise to see there are going to be certain pressure on their revenue and deficit. But they are very diverging picture. If you look at the coastal provinces, they are much better off. But overall, giving the leverage condition, giving the debt burden, giving the property market, yes, that's an important thing to watch for. But a systematic risk could still be avoided. I don't think is the best case scenario because in China is nothing like the western part of the economy, western world. The central government, there's no way to leave them unguarded. The central government, there's no way to just leave the provincial government to be unprotected. So what we could expect to do is to first using the central government budget to help to transfer the debt to switch the burden for the provincial government. Secondly, by doing that, you also try to revive, to set up industrial, for example, industrial innovation fund to try to provide better resources for the government, for those struggling governments to receive more inflow, more revenue. But it's a longer term. It takes some time. In the near term, we have to do the debt restructuring supported by central government. So I will say yes, we have to watch for that, but I don't see a tail risk to be like a systematic risk. And over longer term, there are still a lot of ways to do, supported by central government and also the local SOE reform that still have a lot of assets to sell, that still have a lot of assets to restructure. The only thing is to find and make it more efficient to show more values on their balance sheet.
Thank you, Kevin. It's always nice to see that the Chinese governments, they say something like share prosperity, and then they actually implement the actions and the funds and initiatives to make that happen. They actually walk the talk. I guess that's why we're always so interested to dissect exactly what the Chinese government is saying, because they really do execute what they say they'll do. Unlike many governments that we're familiar with around the world. Anyway, we want to wrap things up. Kevin, thank you so much for your time this evening. I know you're such a busy man. Ladies and gentlemen, if you can't say thank you, please press thank you into the chats for Mr. Kevin. He's really squeezed out time from his very busy schedule. We've rescheduled with Kevin almost 4 times for this session because he's so busy, and we appreciate it so much.
My pleasure as always, Isabelle. I really enjoy the seminar today, and I really appreciate all your efforts for connecting, and I hope I'm looking forward to next connecting, hopefully in the near future.
Absolutely.
My pleasure as always.
Yeah, thank you. We have a small crowd today because it's Raya tomorrow. It's our public holidays for the next 4 days. But we'll be sharing this video on YouTube, and many people will be viewing it as well. So thank you for motivating more foreign fund inflows into your country. You've given us a lot to think about this weekend.
Thank you. Thank you. My pleasure.
All right. Have a great night, Kevin. Thank you.
You too. You too. Have a good holiday.
Thank you. Bye-bye.
Bye.
So right now, we're going to proceed a bit more into insights and strategies to capitalize exactly on what Mr. Kevin has mentioned. So he did cover a lot of, he's a very top-down individual based on his role at CICC Research. He's the managing director over there. And as you've seen before, he's actually been, we saw him on Bloomberg, we've seen him all over the world across international press. So he's a pretty busy guy to get hold of. So thank you so much for encouraging him. time, fellow Malaysians. Right now, we're going to go into structured warrants a bit more, and in particular, the Chinese equity structured warrants, where you can capitalize on what he's mentioned and what Mr. Johan has mentioned. Thank you. So let's have a look at what we're covering today. Who was here on Tuesday? If you were here on Tuesday, can you just write Tuesday, TUES, in the chat box? If you weren't here on Tuesday, just press no. All right, a few Tuesdays over there. Well, let me just give you a short 10-second recap on what we covered on Tuesday. As you can see, this week we had a double dosage. Mr. Kevin, he's not allowed to give stock picks, as I know many of you like, but Mr. Johan, that's why we have a double dose, because Mr. Johan is allowed to do so. Different rules, different rules. So we covered Mr. Johan earlier this week, and today was Mr. Kevin. The video link for Mr. Johan's session is available on our chats. If you guys can just put the chats over there. Part 1 was what happened on Tuesday. So on Tuesday, we covered the big ideas, some fun concepts for beginners, a bit more about ROI and structured warrants and the barbell strategy. We also covered types of structured warrants, advantages, risks, and common mistakes, and the FAQs that people always ask. And today we're going to be covering 2 parts. Well, I think given time, we can cover 1 part, important concepts for beginners. Yeah, let's do that today. So we covered all of this in Tuesday's session. You can check out the webinar video that we'll have on YouTube. You can watch that over the long Raya weekend once you're in between visiting homes and stuff. All right, so this evening for the next 15 minutes or so, I'm just going to cover really quickly the basics of structured warrants, stuff that you need to know before you actually even buy or consider even looking into different products to take advantage of it. The reason being, if I just want to focus on one reason to consider structured warrants tonight, is, let me show you this bit. You can see for structured warrants on the Hong Kong market and China stocks. For the foreign stocks, you can see the reason people actually consider structured warrants in Malaysia. And the reason that the Hong Kong market, it has the most active, largest structured warrants market in the world, is because of the price. So you've got Alibaba. This is the underlying, the mother share as we call it. Some retailers call it. Let me pull down my screen. Yeah. And you can see the underlying bid price, underlying ask price, the warrant bid, and the warrant ask. You can see that it is pretty pricey at 94 Hong Kong dollars. Even CNOC is 12 Hong Kong dollars. JD.com is 146. And Ping An is 54. So that's really the reason that people consider trading structured warrants for these companies. Correspondingly, the structured warrants would be 20 cents, 27 cents, 7 cents, 27 cents. So you can see that's why the logic is, rather than me telling you, yeah, after you watch this session, go and pick up a Hong Kong stock or a China stock, whatever it may be. The main reason is because the absolute price for many of these counters, like Mr. Kevin mentioned just now, the leaders in the market, they can be quite high price in absolute terms. So if some stock that is 100 Hong Kong dollars increases to 110, that is only a 10% return. However, if that happens for structured warrants, the gains are magnified greatly due to the gearing effect. And since we're on this page, we have a new feature that we've put into our live matrix that some individuals may not have noticed, but if you actually just want to look at foreign underlyings and you're not sure which ones are offered by us at Kenanga as a warrants issuer, you can press this button over here. So normally we had the select underlying button, which is next, right above the stock name. where if you choose, for example, Alibaba, then all 2 or 3 of the Alibaba warrants will pop up. But if you press foreign underlying, then automatically all the foreign underlying warrants will pop up on the live matrix. And you can get this right here. That is the source, NagaWarrants.com, and you just head to the live matrix. Anyway, I just wanted to give you the reason why we are even bothering to look at warrants after you've heard such an exciting session about Hong Kong and China markets. That is really the reason why. It's the price. So we're just going to touch a bit of beginner stuff. For those of you who are joining for the first time, if you've actually listened to this part before, no harm listening again. I always feel that you need to listen to things, or maybe I'm just a bit dumb, I feel that I sometimes need to hear things 3 or 4 times before I really understand it. If you're smarter than me, then good for you, but I really feel like I'm the worst at numbers in my whole team. So if you feel that you want to repeat a refresher, let's go. The main question that we always push, or I always mention in all of our webinars, is to always ask, so what? So what? Mr. Kevin has told us all of these things about how possible it is to capitalize on the leaders in the market in China and Hong Kong. So what? How does that affect me, right? In Malaysia, sitting down in Subang this evening, how does that affect us? So really, all of the news, for example, let's choose this. For example, the webinars that are on Bursa Marketplace and Bursa Malaysia, you can get access to a lot of webinars over there. They're free. And I used to attend almost all of them before MCO, but then I attend them online. Or if you attend courses on Masterclass, Khan Academy, Coursera, F1 Trading Academy, the Technical Analysis Academy, you get your news source, CNBC, Bloomberg, BFM, and I find it incredibly useful now that we are focusing more on foreign markets to get foreign objective sources, not just the normal Western side of things, which is CNBC, Bloomberg, and the rest. And notice how I never mentioned Fox News. You need to have a balanced view of what people in the Eastern markets are saying too, right? So consider getting the RTHK. That is a website I really enjoy using. It is Hong Kong news. And if you want a Russian source, there is RT News as well. There are websites, they have shows, and they have an app. Also, all these things from educators, there's a difference between educators and gurus. So many people who actually count as educators to me, they are individuals who've written technical analysis books or books on fundamental analysis. For example, you've got Kirkpatrick, Martin J. Pring, Japanese Candlesticks by Steve Nissan, even our Malaysian authors like Fred Tam, who wrote chart pattern analysis using Malaysian stocks. All these books, I feel they are by real educators who have actually analyzed the market and put into nice theories on how to apply things. And this is compared to individuals that we get plenty of in Malaysia, and these are your gurus. And the issue with these gurus, number one, they are not licensed. So that is a really big issue when it comes to licensing by SC and Bursa. These people are unlicensed and they're just giving you trading ideas without any fundamental or... that one is trade at your own risk, guys, okay? But there is a difference if you can just open your eyes a bit and stop taking the shortcuts. There's a difference between an educator and a guru. A guru is the one that goes rah, 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 bye, 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 bye now, right? But an educator, they tell you the pros and cons objectively and you make your own decision. Also, another source of information is research reports. Now, a bit of a side note. Before I was in my current position, and in my current position, I'm not allowed to trade. I don't trade Malaysian markets. But Well, before I joined Kenanga, and I was still in my learning days, what I did was open brokerage accounts at many different houses so I can actually access their research reports and analyze through there. So I'm not saying that you should do it, but I'm just saying that that's what I did as a young student who was not terribly wealthy. But I was hungry for knowledge. Okay, so you've got all of these different sources, the courses, the news, the books, the educators, the gurus, the research reports, and so what? So you put it into this funnel, you know, the funnel like this, right? You dump all of that stuff on top and you funnel down, you filter into the output, which is really, you just want three things. That's your output out of all of these webinars, courses, books that you read. You really want an entry price, a stop loss price, and a take profit price. So you go through all of that, you analyze the stocks and indexes for entry price, stop loss price, take profit, but maximize the ROI using structured warrants and must-T if you're balancing using the barbell strategy, which is that proportion of your investment portfolio that is in structured warrants, that one maximizes your whole portfolio. So from that output, you would use something like, for example, you go into this bit, Hang Seng warrants, if you're looking at that using the must-T strategy and life matrix, you go through your mistakes, your risks, you ask questions all the time, you find solutions to that. And then you go through, and this is important. It is important to not take shortcuts at this stage because you think you've already got the three most important things right over here. Where's my number 3? The three most important things. But a lot of individuals, we love shortcuts, don't we? And the most dangerous shortcut is this stage. It's when you've got your entry price, your stop loss price, your take profit price. You've understood Hang Seng warrants because you've watched Isabelle's webinars 50 times. And what happens is you skip past this whole bit. You don't analyze your mistakes that you make. And the easiest way to analyze your mistakes is just by looking at your trading results. You know, you get your printouts, right? And you actually analyze each one and understand why you lost on a particular trade, why you gained on a particular trade. Ask about the mistakes and think about how you will never make them again. If you missed an expiry date for a structured warrant, for example, how can you make sure that never happens again so your money doesn't get burnt if it's out of the money warrant? And also another thing that people tend to forget, they are so focused on trading. You know, people ask them what they're so busy doing. Oh, I'm just trading every single day. I'm looking for opportunities. I'm just hungry. I'm just da 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 da. But they don't forget that all of this is just a tool for you to achieve your own personal finance goals. Are you trying to get 30% ROI or return on your investment per year? Is your goal to make 30% every 6 months? Is your goal to make 30% every 1 month? Be extremely clear with your personal finance goals. And don't give me this nonsense of, I want to make as much as possible and I've no goal. The issue with us humans is we have been taught to always think, currently, right, the main train of thoughts in the world is to think positive, think big, you know, you can do it all. Like Grant Cardone says, 10x everything, whatever your goal is, 10 times the goal. But when it comes to trading, you have to be a different person. That person that you are in the real world, talking to your wife, your husband, your girlfriend, your boyfriend, your brother, your sister, your mother, you can be positive, joyful, kind, cheerful. But when it comes to trading and investing, you need to be a ruthless robot. When it hits your goal, your ROI for that month, your target, unless you set a new target, for example, a climbing stop loss, or you have a plan, You hit your targets, pull out of the market. Done. That is your goal for the month. That is your goal for whatever, 6 months. Be very clear with your personal finance goals. If not, 5 years is going to fly by and you would have made money, made money, lost money all over the place. So this goes for your portfolio management, your trading rules. Be ultimately super clear, and your FATA. Fundamental analysis to understand which is a good stock, followed by technical analysis to determine your entry points, stop loss points, and take profit points. Everybody okay so far on the big picture? If you're okay, just press 3 in the chat for me so I know you're still with me. If you're not okay, please press 0. So before we go on to that, I just want to follow through a bit more on technical analysis. Big picture, today is not really a technical analysis course. You can go for plenty of those on Bursa Marketplace and the books I mentioned earlier. There are tons of technical analysis material out there on YouTube even. But something that I find very useful when it comes to analyzing it, the Hang Seng Index, are these 3 tips. But before we go into 3 tips, the first thing to always do is to look at these 3 perspectives before you get started. So the first thing that you should be looking at is pull back to the age of the dinosaurs. Identify. If you can tell me long term, how does the Hang Seng look? There are only 3 answers to this question. I'm not giving away Shopee vouchers for this one. It is more for your own satisfaction. Tell me what this chart looks like. 3 answers. Is it uptrending, downtrending, or sideways? Or it looks like a downtrend followed by an uptrend? Tell me in the chats. Sorry, the chats are a bit far away. I can't really see, but yeah. Tell me, what is it doing long term? Next, you would analyze midterm. If I zoom in a bit more, these were the charts from 2023, February to March. What was it doing? What does it look like? Right? From here to here, there was 1,500 points down, and all I did was the most basic, brainless of technical analysis for you to show you. And that really was just drawing a resistance line right over here. When I saw this bit, right? A reversal candle over there, a bearish engulfing, but we need confirmation before this bearish engulfing. So once it touches the second point, we can start plotting a line already. And over here, let's say I'm the worst trader in the world. I entered only here. So this point, and then when it started, I just drew this line down. Right? You can see it touches here, touches here, touches here, touches here. And let's say when it suddenly just boomed up and it crossed, I use a different color in case you can't see my terrible handwriting, where I'm always drawing on things. I hope you guys don't mind me drawing on my slides all the time because I feel it's easier to see things rather than me just talking and you don't really see exactly what I'm circling over here, right? So when it breaks out of that resistance, it shows a reversal in trend. And let's say I was too slow, right? A normal trader who has time to look at the market 24/7 anyway. So I only noticed it after it closed on that day, and the next day I exited. So here to here, you will notice that from that range, it is approximately, even if I'm the worst trader in the world, that's about 1,000. Oh, actually, it's about 1,500 points, right? So from 3rd February to 3rd March this year, that was easily 22,000 when the Hang Seng to 2,500. And that is 1,000 points down. Now you're saying, oh, nice, but how does it affect me, right? What for? So if you just look at, let's say the Hang Seng HKR, HSI HKR, one of our structured warrants, not looking at time value decay because that exists as well. So we're just doing a really superficial view, but remember there's time value decay which can really erode your profits. That's why we don't look at it for an extremely long term. We're looking at a 1 month maximum term. So even if it's 500 points down, the ROI from that structured warrants would be approximately, let's say, 33%, 500 points. If it's times 3, or even times 2, giving time value theta decay, right? Time value decay, that will still be 66% in approximately 1 month. Doable, brainless. I think this and this is pretty brainless. That's just me. Thank you so much for bringing my phone over. Nice. All right, I'll answer those questions in a moment. Oh yeah, before we go on, so we've covered looking at the long term. First thing you always got to do is look at long term, then medium term, and then intraday, right? So we have a lot of traders that enjoy trading intraday because there are a lot of opportunities. But a tip for those who are trading intraday is this. So I would say 3 things when it comes to trading intraday, or let's say a short term, 3 days to 5 days. Consider superimposing the live matrix onto the chart. We're developing a tool for this, I promise you, but it's not out yet. So let's say the live matrix is over here for HSI, HKR. And I can see that 19391 is here, 19307 is here, 19228 is roughly here, 19151, 19078. So what I did really was just plot the price of the warrant, and I just used a normal trading software. This is just a trading view chart because I know you guys use trading view, so I just decided to use that one for this example. And this is an intraday chart. You can see this is at 9 a.m., 1:30 p.m., and 4 p.m. You can see that intraday, even if it didn't enter over here at a high, whenever I put a plus sign, that is my signal to just take notice. Take notice is like opening your eyeballs, right? And I notice something here, I notice something here, and immediately, what do you see? Downtrending, right? So an easy way to just pull and not get so confused by entering at a high and exiting at a low, if you're an intraday trader, is to actually consider using Bollinger Bands and stop SNR, which is support and resistance lines. I realized that it is very useful. You can see for Bollinger Bands, over here is the bottom. So you would avoid selling at the bottom, for example, and you would avoid buying at the top, right? That'll be the opposite of what you're trying to do, what you're trying to achieve. And I believe that Bollinger Bands are extremely useful and support and resistance when it comes to intraday trading. Now, I feel that for the Hang Seng Index, it likes to follow round numbers, psychological numbers a lot. And if you actually do a lot of these resistance lines like these, they work for long-term, mid-term, one-day candlestick charts. But when it comes to support and resistance, and when it comes to intraday, and you use these kind of lines, they're not so effective. Just to take note. That's my observation. If it works for you, then it works for you, but that's just me. And finally, number 3 is to find a confluence. A confluence means when many things happen at the same time. So like Michelle Yeoh's movie, Everything Everywhere All at Once, what we like is a confluence. That means many things happening at the same time, many indicators showing the same thing. So a confluence would be something like this. You notice it is downtrending already. Let me choose a different color. You notice it's downtrending already. You notice it is also below the moving average. You notice it is also at the top of the Bollinger Band. So then you may consider something like a put warrant because there are 3 things already. It's a confluence of the double top over here, confluence of a downtrending, right? Lower highs every single time. When it's uptrend, it's higher highs and higher lows. When it's downtrending, it is lower highs and lower lows, right? Lower lows, lower lows. And the third thing that you notice is that the top of the Bollinger Band, which is a beautiful opportunity to enter. And the same thing goes for exiting. You notice over here, what are we looking at? The same thing. We notice there is a reversal of trend. If you want to draw, like I said, support and resistance lines work better than just drawing what is this called? A downtrending line, right? A horizontal line works better for me. So you will notice over here, something is going on. And you'll notice that this one, these are increasing. Then it's time to exit your put warrants, for example. So those are the three things I would look at if I was trading the Hang Seng Index. If I resign from this job and I go into trading, that's what I'll be looking at. Just saying. So equity warrants ingredients. Today we're going to cover a bit more on the basics. Ooh, we're actually running out of time. We'll cover this one really quickly. When it comes to equity warrant ingredients, you've got a few pricing ingredients when it comes to baking your cake of a warrant. So the main ingredients would be underlying price, exercise price, time to expiry, volatility, interest rates, and dividends. You put this into a Black-Scholes-Merton option pricing formula or whatever option pricing formula is, and it spits out the warrant price. So for example, here is Ta'an, the Malaysian equity, and this is the underlying bid, underlying ask, and it actually spits out 36 cents. And how does this affect me as a trader, right? The main thing to remember as a trader is that, let me zoom in a bit. So what happens is Ta'an is the underlying share, underlying stock, or the underlying asset. Ta'an CQ is the warrant. So the Ta'an price is at 548, as you noticed over here. $548. The exercise price for Ta'an CQ is $388. If anybody can tell me if Ta'an CQ is in the money, at the money, or out of the money, write it in the chats. And the time to expiry for this one was 5th September 2022. This was last year's warrant, and the ratio was 5:1, and volatility, interest rates, dividends, etc. The main thing is if you want to actually know how to price warrants, I know some people are quite curious to know, do issuers just pluck it out of thin air? Unfortunately, we don't, okay? Well, fortunately for you, we don't. As you can see, all you need to do to calculate the warrant's price and followed by intrinsic value and time value is you just take 548. Nobody's answering my in the money, at the money, out of the money question. Very disappointing, guys. I've seen many of your names before. Is Ta'an CQ in the money, at the money, or out of the money? Thank you, Stefan. In the money. And Yuk Long Liu and Fong Kian. Good. 548 is the price over here, minus 388. That is the strike, right? The 548 minus 388 divided by 5, which is the ratio, that is 32 cents. So that's how we get this number over here. 32 cents. 36 minus 32, 4 cents. So now we know the time value of that warrant. And you would compare that with Hang Seng Index. All right, same thing as well. You get the picture. You compare that with something that is in our next session, which is moneyness and time value decay. So the same example that I'm pulling up is Ta'an CQ. If it's at the money, that means if Ta'an, the underlying, is 3 ringgit, it is below 388. 388 is here, that means it's below. Wait, sorry. What is going on with my slides? This one is a bit funky. This one should be the other way around. It should be $3.388. You know what? We won't cover that today because this slide is a bit strange. Anyway, what I wanted to show you for this session is out of the money warrants. So let's say if an index warrant like Hang Seng Index, if the strike price, the exercise price is 28,000, right? 28,000, 28,000 for HSI CQ7. If the Hang Seng Index is 29,000, that is above 28,000, it is in the money. If it is 28,000 equals to 28,000 currently, that is at the money. And if it's 21,000, like it is currently in this range, it is out of the money. This really means that what you're trading is an out of the money warrant. So, for example, can you be trading out of the money warrants? The answer is yes. There is still time value in these warrants, even though there is practically no intrinsic value. But you got to remember one thing, and that is to exit the position before the expiry date. So if you know the expiry date is coming up soon, try to avoid trading it or try to always remember to exit the position and not wait for the cash settlement to kick in if you're trading an out of the money warrant. That really is the number one thing to remember when it comes to moneyness of structured warrants. Now, I'm just going to wrap things up because it's 10 p.m. on the dot. So we've covered two little things. Let's see. Tiang Kao Fu, the question and answer time is... All right, we can close the slides. Thank you, guys. Tiang Kao Fu is, where can I get a replay of the webinar? That's on our Kenanga YouTube channel. If I can get my fantastic webinar support team at Cloud E Events to send the link over for our YouTube channel. Seong Kok Tan, no problem for missing it. Joanne Louis, so what, why, how, where are important elements in investing? Yes. If you had a great key takeaway from today's session, please write it on our Kenanga Facebook group. We'll send the link over as well, and you can get those Shopee vouchers. And even if we haven't announced the winners yet for Tuesday session, but if you have a really great key takeaway and our group marketing chooses you, then you can win another voucher today. There's no limit to that. Joanne Louis, where can we get research reports from Hong Kong Market Daily? Actually, we can go and talk to CICC and hopefully I can get something for you if that's what you're interested in. If any of you are interested in getting Hong Kong Market Research reports, can you just press RR in the chats so we can, should we know there's interest. Learn tips on where to obtain research reports. All right, Tiong Kok, I'll do that along with Joanne. So if you're interested to get some Hong Kong research reports, let me know and I'll cover that in our next webinar or I'll post them on our Telegram. Seong Kok Tan, how to measure successful traders based on your experience. My gauge for successful traders is somebody who is well balanced all around. I'm more interested in a successful human being, meaning, let's see, if you can just pull up my slides for a moment, guys. I'm more interested in the Wheel of Life concept if somebody has their business, career, finance, so trader is the finance part, right? Their health is good, 10 out of 10, family and friends, 10 out of 10, romance, 10 out of 10. Okay, I'm not being crazy, maybe 8 out of 10 for each one, right? 8 out of 10, 8 out of 10, 8 out of 10. Fun and recreation, they're having a good time with life, they're in a nice environment, 8 out of 10. So that's my view more for a successful trader, not so much on ROI returns. Seems to be downtrend, excellent. Really great answers on the HSI, guys. Well done, Joanne. And Dorothy, we'll send over the link, sure. And that wraps it up. I've answered all of your questions. I've had a quick look through. And remember, thank you so much for joining us here today. CP Ng, have a restful weekend as well. It was really quite a stretch to invite Mr. Kevin over. As you know, he was just on Bloomberg recently, like I mentioned, and is quite, a busy fellow. The main thing that you guys can do if you want to actually get more of our foreign research houses and let me organize more foreign speakers for you, is just one thing. And that really is to just comment on the Facebook group. for Kenanga Group. Even if you don't write the 3 key takeaways, it's fine. Just write something that you would like to see more speakers and more webinars, and that can go a long way into stretching our budget and giving you more webinars on different markets. So that wraps it up. Thank you very much. Have a great Raya weekend, everybody, and thank you again for joining all of us here on this Thursday evening. If you're driving anywhere, have a safe drive, and I wish you the most restful, relaxing holidays. And hopefully you can watch Johan's webinar that we've posted on YouTube as well. It's only an hour, and that's your one incremental Kaizen thing you can do this weekend. Bye.